Money Arata. Right after Bitcoin's creation, a computer scientist called halving made some calculations, the results of which you might find impossible. He said that, with time, each Bitcoin could be worth $10 million. And this scenario would only happen if Bitcoin became the main currency around the world. Now, there's something important here. He was very clearly describing all of this as an amusing thought experiment. In other words, he was not taking himself too seriously, and he was not trying to make any price predictions. However, there are other models that are presented as scientific calculations to make more specific predictions about prices and dates. And one of these models is called stock-to-flow. Not that long ago, the calculations of one specific person, Plan B, were trending on social media. And this specific calculation was based on the general idea of stock-to-flow, which already existed for quite a while. And the idea of applying stock-to-flow to Bitcoin was already an idea analyzed by other economists, however, without any specific price prediction, which explained why it gained so much attention at the time. But that specific calculation ended up becoming viral on social media by making a very bullish prediction that Bitcoin's price could surpass $1 million in a few years. The theory is very easy to understand. Stock-to-flow is the number that you get when you compare the stock of a product with its production flow. Today, Bitcoin has a higher stock-to-flow number than silver, a little bit less than gold. And as halvings happen and the number of Bitcoins issued drops by half, Bitcoin's stock-to-flow will surpass gold's, and that is why the Bitcoin's worth could surpass $1 million. So even if you think that you have already lost the chance to invest in Bitcoin, pay attention to this mathematical model that we're going to explain right now, because there are a lot of lies and just wrong assumptions that we need to clarify here. This is not financial advice. Please read the full disclaimer before proceeding. In order to understand prices, we need to understand basic market laws and the laws of physics. Now let's review a basic concept that even children at primary school learn. Price is influenced by the supply and the demand curves. The more products available on the market, the higher the supply, and thus the harder it is to charge a high price for those products. As the price of a product starts to get higher, as long as they have still higher profits, what will happen? Other people may take an interest in also offering that product. However, as the production flow starts to rise, there is a possibility of supply becoming higher than the demand. Too much product. And if the scarcity levels decrease, so does the price. As we have already learned in episode number 2 of the Money Arata series, this happens because of the laws of physics. If it is physically possible for anyone to add more products to the market in a productive way, that's what's going to happen. Now keep calm, you don't need to be a mathematician or a physicist to understand what we're going to explain here. After understanding some basic concepts, you will understand the stock-to-flow and its relation to the price of Bitcoin. Take a basic concept of supply and demand as an example. The supply and demand law helps to define the price of any commodity. A commodity is a product that you can easily exchange for another, such as rice or soy or iron ore. And when we're talking about these products, the increase in the quantity of production causes the prices to drop if the supply rises as well. Therefore, someone who has a high supply of that particular product and was planning to sell some of it will incur losses due to the production increase and the high supply of that product in the market. In this case, the increase of supply caused the extra production to make the product cheaper. When there is an abundance of a product, the producer will not be able to charge a high price for it since there is too much competition. The competition is strong, and the people end up buying from the cheapest offer available. The opposite is also true. The more scarce a product, the more expensive it can get. There is also the theory that precious metals are valuable because of the scarcity. The more scarce, the more expensive. Scarcity can be measured. However, there is still a lot of confusion about the use of stock to flow in understanding and even predicting the price of Bitcoin. The idea of stock to flow is quite old. You can even find it in classical mathematical economics books. And that concept has been applied to Bitcoin as a comprehension model of how solid, how sound this type of money could be. Cheers to Saifedean Ammous. In other words, not long ago, the idea of applying stock to flow to Bitcoin was well known among the market participants. But then suddenly, the concept of stock to flow started to become viral, along with many articles predicting great profit for people who bought Bitcoin intending to sell it in a short term. A statistical model published in 2019 gained a lot of attention by the general public. The model contained some calculations to measure Bitcoin's stock to flow and predicted the price of $55,000 to 1 Bitcoin after May 2020, and also $288,000 a Bitcoin in the near future. Now, an important detail here is that we have to always keep in mind that nobody has the ability to predict the future. Another important point to keep in mind is that even though scarcity can be measured, we should not confuse scarcity with the ratio between stock and flow, the stock to flow. Stock is the quantity of reserves that exists of a product. Flow is the yearly production of that same product. Keep in mind the basics of what we just talked about here. Scarcity impacts the price. However, scarcity depends on supply and demand. If there is little to no supply, this does not mean a lot. If there is little to no demand, the price will be low. And what is supply? Supply exists when the product is up for sale. That product can be offered and can have two origins. It can either be a product that was already in the stock and only now is being offered in the market, or it can be new product that didn't exist before and is being sold instead of being stored in a stock. Take notice that stock divided by flow will not necessarily indicate scarcity. Precious metals have high stock to flow, and that is an indicator of low volatility. To be even clearer, let's see a few practical examples of some metals. Gold has a stock to flow of 62, SF62. There is a stock of 185,000 tons and a flow of 3,000 tons of new gold that is produced every year. So dividing stock to flow, we have SF62. Silver has SF22. There is a stock of 550,000 tons of silver in the world and a flow of 25,000 tons of silver produced every year. Platinum has SF of only 0.4. There is a stock of 86 tons of platinum and a flow of 225 tons of platinum produced every year. Now you might be asking, okay, how is platinum's flow higher than the stock? This is very simple. As soon as the platinum is produced, it's already on the market. There are not many people around the world stocking platinum, but with gold, it's the opposite. The people who have a considerable amount of gold keep it very well stored. Between those three examples, notice that gold has the higher stock to flow, SF62. It is followed by silver with SF22 and platinum with SF0.4. And gold's market cap is also very high. It's over $8 trillion, while silver's market cap is 300 billion and platinum's market cap is only 2 billion. Gold is more valuable, and it also has the highest SF value. So in practice, high stock to flow indicates higher price stability, since it means just that there is a huge amount of product in stock, and thus the probability of a sudden scarcity, a supply shock, is very low. Since proportionally there is stock so large compared to a very small amount of new yearly flow, even if there is some volatility in the demand or in the production, the market agents with a large stock will be able to sell the quantity of the product that they want. Now, the opposite is also true. Products with low stock to flow, with proportionally low stock, they can have their price oscillating more when they're faced with supply shortages. The laws of physics make it very hard to manipulate the physical product's scarcity. Now let's go back to the case of platinum with only 0.4 SF. Could it be that just increasing platinum's stock to flow that would also help to increase the price? That is, by increasing the stock and reducing the production of new platinum. Maybe some people think that there is a way of forcing platinum to become more valuable in the market by simply stocking large quantities of it and also controlling the production, decreasing its flow. If the stock increases and vendors are still preventing people and enterprises from getting access to platinum, and if the flow decreases, putting less platinum in the market, then prices will go up, right? Wrong. First things first, what we're describing here is not the stock to flow index making the price increase. In this example, the reason for the price increase is although demand didn't change, now there is less supply. Of course, there are some exceptions, but the rule is this. As soon as prices start to go up, causing a profit increase, the production will increase. Someone, somewhere across the world, will take advantage of the attractive net profit due to the price increase. They will find a way to obtain gains with it. And when that new platinum enters the market, then the prices will drop. Not only thanks to the market laws of supply and demand, but mostly because of laws of physics. If it is physically possible to find a way to put more product onto the market and make a profit doing so, well, that's what's going to happen. And in that aspect, Bitcoin stands alone. It is physically impossible to put more than 21 million Bitcoins into the market. Programmed scarcity exists here. Since the quantity of gold in the planet Earth is limited, it is very hard to increase the production of gold in an economically viable way. Yeah, there are some gold sources deep down in the ocean and also in some asteroids. However, current technology does not allow us viably to extract it due to physical limitations. The gold production, the flow, is limited. In a similar way, the Bitcoin production flow is also limited. And it is like that on purpose. It was programmed to be like that. The Bitcoin software limits the total emission of Bitcoins to a little less than 21 million units. We can say that Bitcoin's production flow is more limited than gold itself, as the extraction of more gold simply depends on advances of technology. There is the possibility of technology allowing us to do some gold mining in the asteroids or in deep waters very soon. However, the amount of new Bitcoin produced every year is mathematically predictable and limited. Therefore, we can guarantee there will never be more than 21 million Bitcoin in circulation. This programmed and predictable scarcity is excellent for the application of the stock-to-flow model. Every 4 years, the emission of Bitcoin drops by half in a process known as halving. For the stock-to-flow model, knowing that there is a defined scarcity is excellent. It would be even better to know when that scarcity will increase. And guess what? The Bitcoin software allows us exactly that, thanks to a process known as halving. Okay, now hold on, I'll explain exactly what it is. The Bitcoin emission, the creation of Bitcoin, is made in a process known as proof-of-work mining. The people, the enterprises involved are called miners, and they invest a lot in equipment and electricity to participate. And when those miners help to validate transactions made on the Bitcoin network by making complex calculations, they are rewarded with new Bitcoin. However, mining gets harder over time. When the first Bitcoins were mined, there was little to no competition, and very low computational power was required. That is why we can say that it was relatively easy to mine. With only a few machines, you could receive a great reward in Bitcoin. However, as time passes, and as Bitcoin becomes more popular, there is higher competition in the mining activity. In addition, the reward decreases with every halving. Every 4 years approximately, the Bitcoin software is programmed to execute a halving. In 2012, 2016, 2020, 2024, a Bitcoin's halving is the reduction by half in the emission of Bitcoins every 4 years approximately. When that happens, the flow decreases, and that is why scarcity increases, and that's why the price tends to increase as well. This was all done on purpose to make Bitcoin a strong currency, a scarce, and therefore valuable asset. You can easily learn today how many bitcoins are already mined and are already circulating, besides having a good mathematical prediction of how many bitcoins will be mined in the next few years. This way, halving creates a higher scarcity of bitcoin, which also serves to make the price go up. After all, according to the good old supply and demand law, the more scarcity an asset has and the greater the demand, the more people are willing to pay money for it and get that good. Due to the halving process, we can be sure that every 4 years, scarcity will increase and therefore the price will also increase as long as demand exists. Now the question is, how much will the price go up? Is it possible to have an idea of how the price of Bitcoin will behave over the next years? Is it possible to know if the current price is low or high at the moment, so if it's worth buying, yes or no? A way to answer these questions is by applying the stock-to-flow model with a few adjustments depending on the stock amount, the total bitcoins already issued, and the flow, the quantity of new bitcoins issued every year following the halving process. However, as we just explained, it is impossible to predict the future. Besides, there is a lot of criticism in a specific methodology that has been applied to use the stock-to-flow model to Bitcoin. Stock-to-flow is just a mathematical model, and there is nothing that can predict the price of Bitcoin over the years. Let's sum up what we talked about here until now so you can clearly understand what the stock-to-flow model is and how to use it. When we're talking about Bitcoin, we need to keep in mind that the total number of Bitcoin that will be issued was going to be a little bit less than 21 million. Also, we need to keep in mind that flow is going to be impacted every 4 years when a halving happens. Then it makes the emission even more difficult, and therefore it will be increasing the scarcity in a particular day. Now, the controversy around here is centered around some people who support the use of the stock-to-flow model to quantify scarcity. Remember, stock is the quantity of Bitcoin that has already been issued. Flow is the yearly emission of new units of Bitcoin. No mathematical model is capable of predicting future prices in a foolproof way. If you're buying Bitcoin just because you heard people online talking about millionaire prices in the future, I'm very sorry, but this is not what it takes to be an investor. It's not even what it takes to be a speculator. This is plainly being a gambler. Again, nobody has the ability to predict the future. Stock-to-flow, whether being presented in a theoretical way in books or in specific calculations that are being shared on social media, it's just an analysis model. And humility is very important here. Notice how Hal Finney was just making a amusing thought experiment when he was writing that Bitcoin, maybe it could be worth $10 million. This kind of calculation is nice to make because it's going to be useful for you to be thinking about potential different scenarios. However, you have to be very careful. Avoid following blindly people who are going around on social media predicting prices and setting target dates. They may even get some things right sometimes, but it doesn't guarantee you any results in the future whatsoever, even by creating some mathematical model. For the calculations to represent reality, it is not enough to just look at the supply curves and notice that there is a limited quantity of Bitcoin in the world. We also need to look and be mindful of the demand curve, because people's interest in Bitcoin has to stay still, steady, or increase. It is very likely that this will happen. However, because we're talking here about human behavior, there are no guarantees. And above all, the market narrative is what truly has the capacity of moving prices. For example, if some governments create a global aliens to coordinate attacks and create laws against the use of and also the ownership of Bitcoin, even though such laws would be very hard to actually implement in practice, just the fear alone could cause a result in a decrease of the interest in Bitcoin. We can imagine the opposite. Imagine a race between the wealthiest nation-states and corporations in the world to be accumulating Bitcoin. These events are not predictable in any mathematical model. The stock-to-flow model doesn't make endless speculations about all these scenarios. It only takes into consideration the stock and the flow of Bitcoin. It doesn't even take into consideration the exact fundamental components of price, such as supply and demand. On the one hand, a high stock-to-flow number indicates how sound a particular money can be, and it also represents a unique characteristic of Bitcoin, which is it is impossible to create more of it than has been planned. And according to that model, Bitcoin is an asset with great potential. Now, on the other side, a good analysis is not based on a single model alone. The variables of human behavior, from government regulation and new technologies, maybe more advanced than Bitcoin, they're all subjects for other episodes here in the Money Arata series and for our Diamond Hands course. What needs to be very clear here is that there is a great opportunity for you to get benefit from Bitcoin as long as you understand the fundamentals of investing. In the Diamond Hands course, you take a deeper look into the alternatives that are viable for both long-term and short-term investors, so that it will be possible to use the stock-to-flow model along with other ideas, other strategies aiming at higher gains and more secure investments. Stock-to-flow is an old concept from mathematical economics. It has been published in the Bitcoin literature in general, and also went viral on social media due to the price predictions. Now, be very careful with viral internet content, especially when it is too optimistic, too bullish, projecting higher prices for the future. Nobody has that power. However, you're able to learn models that go way beyond stock-to-flow. And the good news is that Arata Academy summarized all the lessons that you need to do all of that in a language that is easy for you to understand and to put into practice. And you can get to know it right now in the Diamond Hands course. And I invite you to take a look at our special class by visiting the link arata.se/diamondhands.